Hi, everybody. Jim Kruzan here, and welcome to the April Market and Economic Update. In this episode, we'll talk a little bit about any changes we may have seen in the economy and what impact they might have had on the stock market for the month of April. First and foremost, as it happens every month, the leading economic index came out. This was reported out just last week, April 30th, and it showed another drop in the economic index. One interesting point is the month before, which initially showed a drop, it was revised upward a bit, but the drop last month far surpassed the amount that it was adjusted upward. This is really strange as it's been dropping now for well over 3 years, and we have yet to see any real disruption in the economy. Maybe part of that is this so-called K-shaped recovery, where you have at one end very affluent people continuing to spend, corporations spending on capital investments such as AI. But at the other end, you've got many consumers, most consumers that are really having a hard time. And that has helped kind of prop the economy up. I'm talking about the spending, AI, and affluent spending. And as a result, this slowdown that we've been expecting is just taking a whole lot longer to materialize. Data beyond that is still very much a mixed bag. If you look at, and we're not going to go through it all, but look at a couple of these data points, credit card delinquency rates, they're very high, 12.7%, up from 12.4 the quarter before, and up from 11.3 just a year ago. Not the optics you'd expect if the economy is smooth sailing. We should see the update to this for the last quarter, May 12th, I think is reported out at 11 o'clock. We'll be watching that very closely. In addition, there's been somewhat of a mixed bag in terms of manufacturing. Manufacturing has generally been weak for the last 3 years. We're beginning to see a little bit of life with respect to that. We don't know if that's a result of this respite with respect to tariffs, and companies are kind of building up some inventory because of that, or the expected cost increases because of fuel cost. We're not quite so sure, but it's somewhat of a mixed bag. We saw the ISM number. It actually improved a bit. The manufacturing orders were somewhat flattish. Philly was a bit of an improvement. Chicago was a bit of a drop, weakened, and the Empire number was a bit of an improvement. That said, other data points are mixed. Real estate, existing home sales fell, and at the same time, PPI and CPI, the inflation numbers rose. On the employment front, again, a bit of a mixed bag. Jobless claims decreased a little bit, meaning less unemployment claims. ADP survey showed 62,000 new jobs created. That was a bit better than expected. The JOLTS number, which is the number of new job openings versus kind of layoffs, the jobs opening number fell quite a bit, much worse than expected. And what we're kind of seeing there is this no hire, no fire environment. In terms of market and market valuation, we had a big upsurge in valuations. All the major indices were up in April, almost a complete reversal of March. So we're right back to really high valuations. If you remember back in December, this Buffett indicator that shows relative market value to GDP was as high as it ever was at 230. That value as of just this week, or I should say just last week, was 226. So we're flirting at those all-time historic valuations. In addition, the Shiller index, which academics prefer to use, which has to do with PE. So it takes into consideration the total corporation's profits wherever they're made, as opposed to those that are restricted to the US economy. We're at near all-time highs as well, just a hair under 40, which is about as high as we've ever seen. once the index grew above 40. That was during the dot-com bubble. So what does this mean in terms of the market itself and the various indices? I said April was a bit of a reversal. The S&P 500 was up 10%, causing the S&P to go from being down 5% for the year in March to being up just over 5% on the year by the end of April. And you can see that most of the indices were not only up in April, but are up a bit during the full year. The exception is bonds and fixed income. They had a bad month last month and a continuation of a bad year. Gold also fell a bit last month. And as a result, you've got kind of a mixed bag. Balanced stock funds, those that are 60, 40, 70, 30, had a bit of a drag because of fixed income. And once again, we're back to a point where you look at the Mag 7, those big tech stocks that have been mostly involved with AI. Right now, those 7 represent 34% of the S&P 500 index. By cap weighting, that's about as high as we've ever seen. And the top 10 largest stocks in the S&P now represent over 40% of the index. We've been there a couple times before. Just to put it in perspective, during the dot-com bubble, when valuations were as high as ever before seen, the top 10 names represented about 20% of the index. And you can see exactly how April's returns were to a good degree created by some of this Mag 7 return as well. So that's kind of it. That's what we saw in April. We'll see how May performs. So far, so good. If you have any questions, please reach out. Once again, thanks for watching. And if there's anything we can do, please let us know. Have a great day.